What happens when the country responsible for powering the entire AI revolution loses over $2 trillion in market value in under 30 days? Right now, while Wall Street analysts debate whether AI is a bubble or a new revolution, the epicenter of global memory chip supply chains just experienced one of the most violent stock market collapses in modern history. South Korea's main stock index, the KOSPI, just crashed over 40% from its peak. Trading was forcibly halted by emergency circuit breakers as semiconductor titans like SK Hynix and Samsung saw 50% of their market value evaporate almost overnight. Now, this wasn't just a routine market pullback. South Korea is the canary in the coal mine for the entire global tech economy. If companies making the hardware for Nvidia and OpenAI are suddenly getting crushed, it means the financial math behind the multi-billion-dollar AI gold rush is officially breaking down. When you hear about Nvidia's multi-thousand-dollar GPUs running AI models like ChatGPT, those processors don't work alone. They require hyper-fast stacked memory chips capable of feeding tens of billions of data points into the brain of the AI every single second. Without this memory, an AI supercomputer is essentially like a Ferrari without a fuel line. Because SK Hynix became the exclusive supplier of HBM chips for Nvidia's top AI processors, money flooded into Seoul at an unprecedented rate. Global hedge funds, Silicon Valley tech giants, and millions of retail investors bought into a simple narrative. No matter who wins the software war, South Korea sells the pickaxe for the AI gold rush. By mid-2026, South Korea was Asia's best performing market, and the KOSPI doubled in less than a year. Local retail traders known in Korea as ants were borrowing heavily to jump into leveraged tech funds. Everyone believed the chip supercycle was gonna last until 2030, until three critical dominoes fell at the exact same time. The first domino was a sudden skepticism around big tech spending on AI infrastructure. For 2 years, Microsoft, Google, Meta, and Amazon spent hundreds of billions of dollars building massive data centers. But Wall Street began asking some brutal questions like, where is the revenue? When major tech corporations started signaling that massive infrastructure capital expenditures weren't generating immediate profits, investors realized that memory chip orders might slow down much sooner than expected. Now, the second domino fell when SK Hynix released its quarterly earnings report. Even though SK Hynix reported record-breaking operational profits, the market's expectations were priced for perfection. When forward margin guidance showed signs of cost pressures and inventory buildup, institutional investors panicked. In a single trading session, SK Hynix plunged over 14%, and Samsung dropped 10% as well. Because these two chip titans make up nearly half of the entire South Korea stock index, their drop triggered an immediate index-wide sell-off. Then came the third and most dangerous domino. Reports surfaced that Chinese memory manufacturer Shaanxi Memory Technologies launched a massive market debut, while state-backed firms initiated mass production of indigenous DUV lithography equipment. For years, Western sanctions aimed to block China from producing advanced semiconductors. But this breakthrough signaled that cheaper Chinese memory chips could soon flood global supply chains, threatening South Korea's pricing power and profit margins. The illusion of a permanent Korea monopoly was shattered overnight. When panic set in, South Korea's unique market structure turned a normal correction into a total catastrophe. Over the past 2 years, retail trading in South Korea has reached extreme levels. Millions of everyday citizens used 2 and 3 times leveraged single stock ETFs to bet on daily moves in Samsung and SK Hynix. When chip stocks began falling, it triggered an automatic margin call across hundreds of thousands of retail accounts. As retail brokers forcefully liquidated positions to cover debt, prices fell further, triggering more margin calls. In less than 40 days, the KOSPI wiped out nearly $2 trillion in market value. It was one of the fastest bear market drops in modern market history. Government officials scrambled to stabilize the market, reviewing emergency restrictions on leveraged products and calling the rapid swings unprecedented, but the damage was already done. This brings us to the core question that every global investor has to ask. Is South Korea an isolated event? Take a look at the similarities between the two markets. Both have extreme concentration. Just 10 stocks account for roughly 69% of all the recent gains in the S&P 500. In Korea, 2 chip makers held almost half the index weight. The other similarity is debt-funded Capex. A growing portion of global AI data center buildouts are now funded through heavy corporate borrowing and off-balance sheet vehicles. US stock market valuation multiples are sitting near levels last seen during the dot-com bubble of 1999. When a market trade becomes this crowded and this leveraged, it doesn't take an economic collapse to pop the bubble. All it takes is a subtle shift in sentiment, a single earnings report, or a hint of oversupply to trigger a rapid unwind. Now, while a post-crash rebound boosted Korean equities temporarily as big tech capex continued, the structural message is clear. The period of unbridled, risk-free AI valuation expansion is officially over. Now, the story about South Korea's AI market pop isn't just about memory chips or leverage. It's a masterclass in what happens when financial engineering and speculative hype outpace real-world economic profits. As capital expenditure cycles adjust and global tech competition accelerates, investors are being forced to separate real operational value from speculative momentum. So here's the question I'm going to leave you with today. If the hardware suppliers powering the AI boom can lose 40% of their value in a single month, despite posting record earnings, is your portfolio prepared for what happens when Wall Street demands proof of real AI profits?